Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Adrian Ash runs the research desk at Bullion Vault. It is the world's largest online investment gold service. He's online at bullionvault.com. He joins us today from London, England. Adrian, good to have you back on This Week in Money.
Thanks for having me, Phil.
Hey, last time we talked at the beginning of December, Canada's Mark Carney, the George Clooney of central banking, had just been named as the new Bank of England governor. Now, a couple of months away. He doesn't start until July, but he was grilled last week by a British parliamentary committee. And the big question was, what would he say about the Bank of England's 2% inflation target? So how did that go with the select committee?
Well, I mean, if you look at the way the media have responded today, you'd think the big question really was which football team he's going to support when he's here. Apparently, I understand he said on Parliament Hill yesterday that he's an Oilers fan back home, but when he gets to England, he's going to be an Everton fan. But it's funny because he obviously hasn't got the memo about politics and football. I mean, Everton is, I don't know, he says he's got some cousins in Liverpool or something. It's interesting. Yeah. I'm an Aston Villa fan, unfortunately. That's because I'm from Birmingham. But for some reason, Aston Villa is the team of choice for people in the public eye. Okay. Prince William, the Prime Minister David Cameron, the current Bank of England Governor Mervyn King, they all apparently are Aston Villa fans, even though none of them come from Birmingham. So I don't know whether it's because we're such a bad team that it doesn't upset other people. I don't know whether that's the aim. But you'd think today from the media that was the big issue rather than the 2% target on inflation. The Bank of England had its quarterly report out just this morning. We know from yesterday's data that inflation in the UK was 2.7% year on year in January. That's the 38th month in succession that inflation has been above the Bank of England's mandated 2% target. I think it's interesting what Mark Carney's backpedaling from the idea of nominal GDP targeting, which some people had floated. It looks like he's going to basically, he can't decide what the target is anyway. I mean, that is officially set by the government of the day. So the bank has already come out and said today that inflation is going to be above the target for another 2 years.
Yeah.
I fully expect Mr. Carney's going to stick with that. He was saying, again, just yesterday, he was saying, there's considerable slack in the Canadian jobs market. That would seem to justify keeping interest rates lower, perhaps, than they would otherwise be for the foreseeable future. And that's exactly the excuse that the Bank of England has already used in the UK now for 5 years. It's situation normal here. As you say, all he needs now is the beard. I understand George Clooney's got a nice full beard now, so if he's going to keep those Hollywood good looks, he's going to have to keep up. But he's got an interesting job coming up. I think managing. It's not so much managing the economy. I mean, I certainly have no faith in central bankers to do that anyway. But in terms of managing the perception and the reputation of the national debt, I think this is going to be a much more interesting challenge for him. And I do think that he might be on watch whilst this comes home to roost for the UK.
Here's an amazing number, Adrian. The Bank of England has so far spent £375 billion, that's $588 billion, on British government debt as it tries to get things going again. That is a large, large number.
It hasn't done a great deal either. All it's managed to do is it's reflated the stock exchange, the stock market. We know that. I mean, the FTSE had its best start to the year in January since 1989. It's most importantly, from a policy point of view, it's managing to keep house prices, particularly in London and the southeast, reflated. It's keeping them up. The bubble has burst in a lot of the rest of the country, particularly in Northern Ireland and Scotland, which were, of course, on the final edge of the credit bubble as it expanded through to 2007. But in London and the southeast, house prices are still at ridiculous multiples of income. And you're still seeing, there is no repricing, there is no re-rating of real estate, residential real estate. So you're increasingly seeing now demands from politicians and from lobby groups, and particularly from the construction industry, that the only way to bring down house prices or to make them more affordable is, of course, to build more. I think, maybe raising interest rates might be another way to do it.
Adrian, what about the consensus view over there that Mark Carney had a pretty easy time of it in Canada because of our resource boom, and he has no experience with the banking crisis or with inflation? How's that going to play over there?
I don't really think that kind of experience actually counts for much either way. I mean, Mervyn King had zero experience of anything other than a benign economic climate when he took the role. That didn't seem to help him either way. And certainly in terms of, how he's been perceived since, Mervyn King, I think, has had a relatively easy ride in terms of media coverage, in terms of political pressure and so on. He's been the right man in the role at the right time. It's interesting to see that Carney's potential replacement in Canada, I forget the guy's name now, but I was looking at him just the other day, and I see that, very similar to Mervyn King and similar to most central bankers these days, he's a career central banker.
Yeah.
He's either a PhD student, and then he goes into the Bank of Canada 20 years ago and stays there. 30 years ago now. It's very much, this is how it works now. You don't have in central banking typically people from outside of the system. You might have a bit of Goldman Sachs experience, which Mr. Carney does, but what you're not getting is people who are actually out in industry, people who are out in business, economists who are actually out there for productive business. They're either financial engineers by trade, academics, or, permanent bureaucrats. And I think it's that kind of experience that politicians will look to, and it's that kind of experience which people like central bankers to have, it would seem.
What about Carney's salary? $1.37 million a year, the world's highest paid central bank chief. How's that playing over there?
Well, maybe it's because he's going to have the most difficult job. I don't know. He certainly hasn't got, the biggest economy to pretend he's in charge of. He's got a currency which I think is likely to come under attack pretty shortly. I think, the G7 statement yesterday was very funny. The idea that the G7, which includes, of course, the US, the UK, the leading Eurozone economies, France and Germany, Canada as well, and, of course, Japan, all saying, we have a commitment to market-determined exchange rates.
Whatever that means.
Well, what it certainly means is how the hell are you going to do that when you do not have market-determined interest rates?
Yeah.
When you will not allow interest rates to find their own level, how on earth do you pretend, how do you look at yourself when you're shaving your George Clooney beard off in the morning, that, you're going to somehow allow the market to set the exchange rate? This is, I think, going to be, the ongoing. The idea of a currency war has suddenly come up again in the mainstream media. But those of us who've been following this properly know it's been around for a long time now. The Bank of England actually kicked that off, really, as the Northern Rock crisis broke in 2007, and then morphed and caught up with the subprime crisis in the States, and then on, obviously, into the global financial crisis of late 2008. The pound lost 20-25% of its value. It had the sharpest fall actually since the Great Depression. The pound has since risen, unfortunately, which means that it's whatever magic the Bank of England was hoping it was going to achieve for exports, for the value of government debt, and so on to overseas investors. It's going to have to do that again. We see what Japan is doing now. You've had a 20% drop in the Japanese yen now. Inside 3 months, you've had a 30% rise in the Nikkei stock market. Obviously, the Bank of England would like to try and replicate that, and so would everybody else. The problem for the bank, I think, here in London is that there is no real structural reason for sterling to be on so many central bank balance sheets. The idea of it becoming a safe haven over the last few months, which you might see some financial commentators talking about, is just absurd. The UK economy remains in a horrible state, I think very much like Japan was 20 years ago. Very overvalued, prone to deflation, soft, slow deflation in house prices, in real wages, in prices. The cost of living has to come down. I mean, it's just a very expensive place to live now globally, and I think arbitrage basically means that we will have that. But it'll come through because the central bank will fight it, and I think that'll make things a lot worse for a lot longer. What they will certainly try and do, though, and I think Mark Carney, this will be at the top of his list, is how do we get the pound devalued quick?
Adrian Nash from BullionVault.com, our guest here on This Week in Money. And I love the British press and some of the comments that they're making, a cult of personality surrounding Governor Carney here. Jeremy Warner in the Daily Telegraph, Carney exuded a certain worldly wise confidence and openness. And here's a crackerjack one from Quentin Letts in the Daily Mail. It was as if Mark Carney had arrived across the street from Westminster wearing snow goggles to fend off the glare.
Well, this is... when you're used to Mervyn King as a central banker, then, anyone's going to look pretty glamorous. But Mark Carney is a good-looking guy. I mean, he's almost got all of his hair. It's going to be interesting to see how that actually plays out. The idea of parachuting in an outside governor, I think, is interesting. I think politically it's already played well. Certainly the City of London seems to like it so far. The Bank of England still carries a lot of respect within the city. And its role is very central, and he's only going to become more powerful, in fact. A lot of the powers that were taken away from the Bank of England 10, 15 years ago by the previous Labour government, those are being returned in full and more by the Tory-led coalition now. So Kai's going to have, it's going to be a big job. Whether he, as you say, whether he can justify that, that number one in the world central banking salary remains to be seen.
Obviously, a lot of this, Adrian, has to do with the upcoming general elections in 2015. Prime Minister Cameron and George Osborne obviously want to get things under control by then, right? And Carney may be the answer to their problems. Problem
there is that they were elected in the coalition because they didn't get a majority, so the Liberal Democrats are in there as well. They were elected on a platform of reducing the deficit and then therefore reducing the debt. They haven't managed to do that, mostly because the economy has shrunk so badly and stayed shrunk over that period of time since 2010 now. We are looking at a triple-dip recession. Another bank said we weren't going to have another quarter of failing growth in the first 3 months of this year, but that remains to be seen. What that means is that they have failed to do what they were elected to do. And they were only elected to do it by, certainly the Conservatives, by, less than a full majority that they needed, so hence the coalition. I think there's a very serious danger that the idea of, which you're seeing elsewhere, of course, which is, no, actually, austerity is not what we need to go back to full-on spending, we should open the spigots again and get this all out there. This will... it's a natural response, I think. I think it's the obvious reaction to the fact that things haven't improved quickly. You have the object lessons of Spain, Greece, potentially Italy as well, about what austerity can be seen to have done to people and what it can be blamed for. Despite the bigger problems obviously being things like non-payment of taxes, structural sclerosis in labour markets and so on, that things that don't get fixed very quickly. Mervyn King was only saying this morning that he can't be responsible as a central banker for fixing the economy, and that central bankers can't carry the full burden of doing this, which is a line which all the major central banks have spun in the last few years. Shirakawa at the Bank of Japan, he's just resigned, of course, but he was saying exactly this in late 2012. Then Bernanke said it, Mario Draghi has said it. Now Shirakawa has gone, of course, the Bank of Japan is being asked to do that, and he's stepping up to the plate and is doing it. It's printing indefinitely, and I think that we're going to see that because the pain that necessarily follows the credit bubble that we've been through in the last 10, 20 years. No one wants to go through that pain. It hasn't worn off quickly. Can't we just get this over and done with? Well, yeah, how about we just go back to the credit bubble and see if that helps? And I do think that's, what we're going to see more globally. I think you're seeing it in expectations of that now in financial markets more broadly. You're certainly seeing in the North American, UK stock markets, Germany as well, less so across Europe. I mean, the Eurozone is still mired very much in a deflationary mindset, but it'll get there, I'm sure. So, this is where the reflation model comes back in. And I think it'll be interesting to see how that plays out for gold and silver investment over the next couple of months, because people are getting a bit bored now. You had Dan Denning, my old colleague from the Daily Reckoning in London, on last week, and Dan rightly said people are getting a bit bored now with kind of sitting out the financial markets and in cash and waiting to see what's when they can get back in, and maybe it's time to get back in simply out of boredom now. And I think that may be what you're seeing in the gold market right now. You're seeing maybe some of the weaker hands, some of the shorter-term holders now saying, actually, this isn't doing what I want it to do, which is go up. It's what people are now expecting gold to do all the time. It's done it for 12 years. So I do think you're seeing maybe a little bit of boredom there creeping in, and some people saying, well, okay, I'm going to call it a day. I'm going to move back into equities.
Going to follow up with you, Adrian, in July and see what's happening on the Mark Carney story.
That would be great. Yeah, it'd be very, as I say, it's going to be very funny to see how that pans out.
Yeah.
And also to see what he inherits by that point as well.
And to see if he switches to Aston Villa by then.
Yeah, maybe he will have got the memo.
Give us a thumbnail sketch, Adrian, on what you do at Bullion Vault and how Bullion Vault works.
Well, Bullion Vault is an online gold and silver exchange for private individuals. We're the largest what we do in the world. Basically enable you as a private investor to buy, own and sell real physical gold and silver bullion. It's all vaulted in professional accredited vaults. It's all held in the form of large wholesale good delivery bars, so you're getting the very best quality. It's all warranted by the procedures of the market, and you own it outright. You're not on anyone else's balance sheet. You're not this is not unallocated You're not exposed to us. We're not exposed to you. There's no credit or leverage or shorting. It's just physical goods in a vault that belong to you. Our online exchange turned over about $1.5 billion worth of gold and silver last year, 2012. As a business, we've been going since 2005. We've now got about 45,000 users worldwide. About 90% of those are in North America and Western Europe. But we are also growing elsewhere now. We have users in Australia, South Africa, and obviously, it's like everybody else in the precious metals business, we're very interested in Asia. So you can store in New York, London, or Zurich. We're now offering silver trading and storage in Zurich as well. We're launching Singapore quite shortly, hopefully. And as a business, we continue to grow and to acquire customers who are either looking to hedge what they have elsewhere, I think, or are looking for more of a short-term safe haven. They're looking to park some money away from the risks that they see in credit, particularly in inflationary bubbles elsewhere.
Adrian Ash runs the research desk at Bullion Vault. It's the world's largest online investment gold service. He's online at bullionvault.com. Hey, Adrian, good to talk to you. Thanks for this.
Thanks very much, Phil. Speak soon.
Coming up, Marin Katusa on This Week in Money.
Always consult your investment professional before making any investment decision. Randy Elvis Frisky and his Las Vegas show band 40th anniversary Aloha Tour. February 23rd in Penticton. February 24th in Vernon. On sale now. Details at randyelvisfrisky.com. This Week in Money is archived online at talkdigitalnetwork.com.
Marin Katusa is Chief Energy Investment Strategist at Casey Research, and he's Senior Editor of the Casey Energy Report. He's online at caseyresearch.com, and we always appreciate talking to him. Hey, Marin, good to have you back here on This Week in Money.
Oh, it's a pleasure.
Oil up 1% this week. It's still below $96 a barrel. We can blame strength in the U.S. dollar for that. The interesting thing that we're scratching our heads about, the discount between WTI, West Texas Intermediate, and Brent crude, the European Brent, it's almost $20 a barrel. Why the spread? Why the difference? Why has it changed so much?
Sure. WTI is the North American pricing. The Brent is what the Europeans are pricing, and their oil is mainly the three main sources you're looking at is obviously North Africa, Middle East, the Russian oil, and the North Sea. So because of all of the political instability in the area, the production delays, and just the high-risk nature of that region right now, there's a premium to Brent. If you go back 5 years ago, it was the opposite. WTI was trading at a premium. Today, it's a much bigger differential. On top of that, in North America, we even have bigger discounts. For example, the Canadians, there's up to a $35, $40 discount for Canadian oil because of the lack of pipeline infrastructure in Canada to get the oil to America or to the coast and ship our oil to the Asians. So even though the WTI price is $96, many of the Canadian oil producers are selling their oil sub $60 per barrel.
Now, are we ever going to get to a situation where there's a little more equilibrium between the three prices?
Well, the whole reason why is we do not have, when I say we, Canadians do not have the refining capacity that the Americans do. Mm-hmm. So we are completely dependent on Americans. Even though they consume our oil, we are dependent on them taking our oil because we can't refine and process our own oil. So that is all based on we produce a heavier oil. And because of the existing infrastructure, there's a glut right now in Pad 2. That's the refining complex.
Okay.
And until we build our infrastructure where we not only build Keystone XL to take it down south all the way further down to Pad 3 to the Gulf of Mexico where there's refining capacity that can take our heavier oil and also the pipeline to the west so we can sell it to the Asians. Until that happens, Canada is losing billions and billions of dollars because the Americans are buying our oil on sale.
Marin Katusa from the Casey Energy Report with us here on This Week in Money. Listen to these amazing oil stats, Marin. U.S. oil consumption dropping every month since last May. U.S. crude imports have fallen 6% this year. That's after falling 21% last year. What's going on? Is this just a simple supply-demand issue here?
Mainly it comes down to the refining complex again because of the crack spreads, because of the slowing of the economy. Remember, Doug Casey has famously stated we're entering the eye of the storm of the Greater Depression. And reality is that with the refining complex, the slowing economy, that's why the numbers are where they're at.
Got a couple of interesting reports on oil came out this week I want to talk to you about. Here's one from Citigroup released this week saying by the middle of this year, the U.S. Gulf Coast will no longer import a light sweet crude. They're going to replace it with domestic supplies. The U.S. oil gets 40% of its oil from OPEC. And obviously, they're not big fans of the energy independence narrative.
Well, look, first of all, the EIA stated these types of numbers in the past where, they said we're going to North America has become a major importer of LNG. These are a bunch of armchair analysts that get it wrong. They make these big calls. The reality is America imports about 1 million barrels a day of heavy oil from Mexico and Venezuela. They are paying almost twice for this heavy oil that they're getting from Venezuela than what they're paying from the Canadians. Yes, right now the Americans have had a massive success with the unconventional technologies, but the reality is because of the prices are sinking so heavily on the gas side of things, and remember, it's the natural gas liquids that have been making this economic. Most of the shale potential is more gassy fields. And with the refining complexes, the companies are not making money right now. So from a theoretical standpoint, the potential is there, but the reality is it's going to take a lot longer to get there, and it's going to cost a lot more money. So I don't agree with the report.
Now, I guess they're probably talking their book here, but what about this new OPEC report? It's warning about the risks involved in shale gas and oil.
Well, sure. How much unconventional potential is coming from OPEC?
None.
Russia is the biggest financier of the NGOs in Europe, anti-shale. And they claim that it's bad for the environment. When was the last time that you heard OPEC and Russia worried about the environment for the Europeans?
A long time.
Well, exactly.
Yeah.
It's because they have so much existing infrastructure, so much money invested in conventional production. They do not want the North Americans and the Europeans to develop their own unconventional resources because they'll take them away from the dependence of oil and gas from the Russians and OPEC. So the OPEC and Russians are doing what is in their best interests.
Sure. Now, why are they focusing here on the technical aspect? That they're talking here about the heavy decline rate with the wells that produce from shale. What's that all about?
The irony of all this is conventional wells also have decline rates. What they're trying to say is that when you go and frack a well, the decline rate, so for example, if your 30-day IP initial production comes out at, let's say, 500 barrels of oil equivalent per day, in about a year, it'll be down to about 200 barrels of oil equivalent production per day. So there's a big decline there. But what they're not saying in the report is because of the massive pressures built up because of this fracking techniques, if you were to do unconventional, first of all, you wouldn't have got 50 barrels from that. You wouldn't even get nowhere near the initial production. The decline rates for unconventional are steep. So what they're saying is you're going to have to drill many more wells to get there, which is correct. But the wells produce at a much higher pressure to begin with. Second thing they talk about also is what the effects of the aquifer is. That's scientifically wrong. So the report is very one-sided, and it's, again, they are writing this report for their best interest.
Why is OPEC focusing on shale as a bad idea? Are there not also risks in conventional oil production?
Oh, massive risks. For example, the number one risk for conventional is what the easiest enhanced oil recovery is what they call water floods. So you pump in water to increase the pressure of your flow rates. Eventually, the density inside one of these reservoirs changes. You could have a rock fall, okay, and the whole production goes from, 3, 4, 5,000 barrels of oil a day to zero in one day. The biggest risk right now in Guahar, and I'm going out to Saudi Arabia. I'm just organizing my trip now that I'm back to work full time. I'm heading out to Saudi Arabia to go and look at these oil fields. And the reality is they've been pumping water at such levels, and this is exactly what's happened in Russia, where they actually do a lot of damage to these reservoirs. They don't talk about that because it's the dirty secret of OPEC. There's a lot of risk to conventional production, especially older production that the national oil companies have not been reinvesting in their infrastructure. So, oil and gas is a very interesting place, but when you start looking at what OPEC's doing, you got to wonder, why are they making these comments?
Well, obviously they're talking their book, right?
Exactly.
Yeah. Marin Katusa from KCResearch.com. What about uranium? Rick Rule here calling it one of the most cyclical and volatile materials he has ever followed. Price has fallen from $75 a pound a couple of years ago down to $43 today. Bring us up to date on uranium.
For sure. There's two types of pricings in uranium. There's the spot price and there's the long-term price. But there's also a contract price. The 2018, so we're talking 5 years out, the delivery for uranium right now is being traded at $68 per pound. The spot is $43. That's over a 50% increase. So these utilities are willing to take the delivery of uranium in 2018, 5 years away, and they're willing to pay $68 a pound. What does this all mean? Today in America, there's 11 mines. There's 11 uranium mines producing around 3.4 million pounds of uranium a year. America imports over 90% of the uranium they consume. 2 out of every 10 houses in America is powered by nuclear energy. Uranium is the fuel. You know what the scary part of that is? 1 in every 10 houses in America are powered by Russian uranium fuel. So in 1960, America was the biggest producer of uranium in the world. In 1960, there were 1,000 uranium mines in America. This is the height of the Cold War, and they produced over 36 million pounds in 1960. Today, in 2012, America produced around 3.4 million pounds. Think about where America's gone in uranium. The existing producers cannot make money at today's spot price. Very few producers, unless they have existing infrastructure, can make money today. Any new production needs north of $60 per pound. It is a fantastic place to be invested in. And in our newsletter, we've done fantastically well. We had one double in the last 3 months, and we've had another one, a 60% gain. We've taken profits on both. It's been a great place to make money in.
Good that you mentioned the newsletter. How can I get involved in something like that?
You can try a free trial, a risk-free trial, at our website. Just go to KCResearch.com and you can try out the KC Energy Report.
Marin Katusa, Chief Energy Investment Strategist at KC Research. He's online at KCResearch.com. Have a great trip, Marin, and take care of yourself, bud.
Thanks a lot. You too.
After the break, Ben Rabidoux on This Week in Money.
Randy Elvis Frisky and his Las Vegas show band 40th Anniversary Aloha Tour. February 23rd in Penticton. February 24th in Vernon. On sale now. Details at RandyElvisFrisky.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Ben Rabidoux from the EconomicAnalyst.com is back with us. Ben provides housing data and analysis to institutional advisors in Canada and the U.S. Hey, Ben is in Toronto next week. He's talking about the economy, housing, and investing trends. A free seminar. There's info at realestate2013.ca. More on that in a minute. But first, Ben, thank you for being here today.
Oh, it's my pleasure as always.
Before we look at real estate around the country, I want to plug your site again because you have more than just great analysis. You got some fantastic charts too. So it's the economicanalyst.com. Let's start in Montreal, Ben, and work our way west. A couple of stats here. Montreal housing starts down 26%. The real estate market hits a wall. Sales down 14%. The Quebec Federation of Real Estate Boards, they say the single-family home market is becoming balanced and the condo market leaning toward a buyer's market. Some of my favorite real estate terms here.
Yeah, look, the story in Montreal is actually an inventory story more than anything else. You're seeing sales that are coming off. I mean, a 14% year-over-year decline in sales is certainly nothing to kind of slough off. But the real story in Montreal is just an absolute unprecedented amount of current MLS inventory. And so when you actually start looking at the inventory compared to the sales, it's completely out of whack. There's a massive imbalance in that market, and it's actually in both segments. Pardon me. It's actually in both segments. The condo segment, you've got months of inventory that are very close to their all-time highs, and in the single detached, it's the same story. So I'm not sure I buy this, balanced in general in the single-family home market. It's just I'm not seeing it there. You've got massive inventory and falling sales. Montreal, I've been saying this for a while. Towards the end of 2012, I was saying by the first quarter of 2013, the mainstream Canadian media will start to clue into how ugly that market really is. And there's a few good reporters in Montreal that are actually talking about that imbalance that you and I are talking about right now. But outside of that, like, no one really seems to have a clue that Canada's second largest metro is just in shambles in the resale market.
Interesting. And of course, it's always good to see throughout the media, sprinkled around the stories about declining sales, are predictions. And as you mentioned, that's really all we have. Here's Royal LePage. They're predicting the average house price in Montreal will grow almost 4% this year. How do they know that?
Well, I have no idea how they know that. The average is always a tricky little metric. It can get skewed pretty easily by changing composition of sales.
Yep.
So, I mean, could you theoretically have a rising average resale price during a period of market instability? You could. I mean, if you see a lot of the condo sales start to weaken, then that leaves you with some higher end homes, so the disproportionate amount of higher end homes selling. And so even though the market is weakening in general, you get an average resale price that's rising. Okay. So, I mean, look, I think it's unlikely that you're going to see average prices up this year in Montreal. But if they're up at all, it's going to be because of some bizarre, changing sales mix that skews the average.
Let's take a look at Toronto, Ben. January sales flat. We've got more inventory problems in the condo market. Of course, a horror story. But the Royal LePage folks say the average house price in Toronto is going to go up 1%.
Look, I think actually in Toronto right now, it really is a kind of, to borrow a tired cliche, it's a two-speed market. You've got the condo market that's starting to come under some pressure. And then you've got the single detached where really at this point there still is a pretty significant lack of inventory. There's really two diverging trends there. Now, the sales numbers from January came in actually surprisingly strong. We've been seeing 20% year-over-year declines. So for them to go from 20% year-over-year declines to a flat market, that was surprising. It's going to be interesting to see whether that can be sustained going forward. But the big story there, again, is in the inventory numbers. Mm-hmm. So what has kind of slid under the radar is that you had total inventory that was up 15% year over year. But where it gets really weird is the Toronto Real Estate Board very quietly made an enormous adjustment to their reported inventory numbers from January of 2012. And what they did is they actually added 12% to the reported inventory from last year. So without that adjustment, inventory was actually up 30% year over year. And that flew under the radar. Nobody really discussed that. I'd kind of mentioned it on my website. People who want to see the screenshots of the 2012 press release, 2013 press release, they see very clearly that there was an enormous adjustment made, and it was not disclosed anywhere. So huge inventory build and a massive inventory build in the condo market. You had total condos for sale in the 416 up 28% year over year. In the 905, they were up 50%.
Wow.
And in the downtown condo core, which is where the bulk of the new construction is taking place, condos for sale were up 42% year over year at a time when sales were down between 5 and 10%. So there's no way to spin that one positively. And I think that the weakness in the condo market will continue to, I think, intensify through 2013. Single detached, I have no idea where the inventory is. It's just still abysmally low inventory there. I suspect at some point that'll start to rebalance a bit. But for the time being, I don't see any real price weakness in the detached market.
Ben Rabidoux from the economicanalyst.com. Ben, I know the Royal LePage folks are happy about Toronto. They're predicting Toronto real estate will rise 1% this year. What if it doesn't? Does anybody know what's going to happen? I want to talk about your free seminar, Toronto Real Estate. What's next?
Yeah, so I'm actually going to be in Toronto. It's next week, so Thursday the 21st. It's a seminar hosted by the Rabidoux Group. And yeah, we're just going to kind of take a look at, first of all, the macro trends from the 10,000-foot level, kind of across Canada, and then zero in a little bit on some of the trends that you and I have been talking about right now in the Toronto market. And we're going to talk, I think, pretty honestly about what Toronto has going for it, and then also where some of the risks may lie. And we're going to look at the consensus views right now about where things are heading, and And then I think David's going to talk about what it would mean if the consensus is wrong, and if in fact we're in line for some sort of a hard landing. What's that going to mean for your investment portfolio? So it should be. I hope it's informative. It is a free seminar, and anyone's welcome to attend. But we do need pre-registration on the website you mentioned.
All right. Toronto real estate. What's next? It's at the Marriott Eaton Centre Hotel in Toronto next Thursday, the 21st, 7 p.m. Realestate2013.ca is where you want to go for more information. Despite all the bad news nationwide, it is different in Calgary. January sales up more than 15% from a year earlier. The Calgary Real Estate Board saying they think Calgary is hot on the heels of a year of recovery. What do you think?
Yeah, well, it's hard to disagree, to be honest. I mean, if you look at the inventory numbers right now, and the sales numbers, there's just, I'm telling you, there's nothing to pressure the Calgary market in the short term from the supply-demand perspective. Now, there are offsetting factors kind of at the macro level in Calgary. So one is that the number of units for sale in that are under construction in Calgary are actually very low. So there's not a lot of new inventory in the pipeline that could be added to supply to kind of pressure it in any meaningful way. But then offsetting that, a trend that for a while was flown under the radar, but all of a sudden in the last few months seems to have kind of sprung to the surface, is the idea that the oil sand, the oil that we're pulling from the oil sands is actually fetching a pretty significant discount compared to other oil prices, and it's actually right now well below the break-even point for new developments in the oil sands. So, it's being a major hit to Alberta's revenue stream. We're starting to see some of the big oil companies put some of their expansion plans on hold and start talking about cutting some of their labor force. So. That's a macro trend that people absolutely should be watching. Calgary is notoriously boom bust, and it's a resource play. So there's a chance there that things could turn on a dime. But for the time being, I can just tell you there's very little to pressure that market.
Ben Rabidoux is our guest here on This Week in Money, and I know you specialize in the big five markets, but I got to mention this for our radio friends in Kelowna. January sales in Kelowna down 5%. Okanagan Mainland Real Estate Board President Rob Shaw blaming the dreary winter weather that keeps people indoors. And if you're shoveling snow right now, try not to laugh, okay?
Yeah, when you start hearing people blaming the weather for a trend that's been going on for a year and a half now, it's a little bit lame. Sales on the West Coast in general have been very low, and it's no surprise. I think that of any market, I think Vancouver and the Lower Mainland's gotten just a ton of press play and media attention. So. There's not much that needs to be said there. The January numbers were terrible. You've got inventory that is near record highs, just below the 2009 high water mark. You had sales that came in very close to their decade lows. You had new listings that were actually above average. Because that was one of the interesting narratives. Is the board was saying, well, sellers, if they don't have to market, and that's what we're seeing.
Yeah.
And they said that with a straight face. But yet when you new listings number, they're really extremely high, and it's extremely high. So I don't know where that narrative is coming from. I don't see anything right now that's going to turn that market around. In fact, the daily numbers for February so far have been atrocious. I mean, we're trending towards very close to 2009 lows in sales. And at this point in 2009, we still weren't sure whether the financial system was even going to survive, right?
Yeah, I remember that.
Sort of sales levels that we're looking at in Vancouver. It's terrible.
Got some predictions here. Royal LePage predicting the average house price in Vancouver will decline by 3% this year, and the Real Estate Board of Greater Vancouver says it is clearly a buyer's market.
Yeah, I agree that it's a buyer's market. That's a given. In terms of Royal LePage, I think they've got the direction right. Yeah. It will be down. I think there's a pretty good chance it's going to be substantially more than 3%. I mean, we're starting to see some sellers capitulating in a major way, and buyers, I think, are just flat out nowhere to be found. I mean, I got to be honest, these February numbers that I'm seeing so far are shockingly bad.
Okay.
So I think it's going to catch everyone off guard unless there's some sort of a major resurgence in the second half of February. I mean, it's going to be bad print when those numbers hit the market.
Want you to check out Ben's latest story at globeandmail.com, or if you're still using the old newspaper method, you need to find Tuesday's Globe and Mail. The headline is, Why a Soft Landing for Housing Could Still Hurt the Economy. I guess we should start here, Ben, with a look at what role real estate plays in our economy. How much of GDP does housing and the housing industry represent? Any idea?
Well, there's a few different estimates. I know CMHC has estimated it in the ballpark at 20%. Now, what I've done is I look at the finance, insurance, real estate industry plus construction. And those two industries collectively account for 27% of GDP, which is up substantially in the last decade. In fact, if you go back to 2005, 45% of our GDP growth in Canada can be attributed to growth in those industries. Now, I have to be honest, those paint a bigger picture than would, is necessary, I guess. We know that not all construction is related to the construction of homes, for example, right? So we're drawing a bigger picture than necessary, but it's still, those industries are an excellent proxy for real estate activity in the general economy. And they are an enormous portion of our economy, much, much higher than they ever were in the U.S. I think it's funny when I talk to some people who think that the U.S. at the peak was basically just, it was just essentially real estate and banking. And that's all they had going for them. And that's not the case at all. The U.S. was phenomenally a diversified economy, much more so than we are here in Canada. So, there's a risk there that if we see a quote-unquote soft landing in housing, it's going to weigh on those industries. Those have been the big driver of our economy. I'm not sure what's going to rise up to take their place. So you're going to have a substantial drag on GDP growth and on the labor market. And in fact, one of the things we saw last week that caught everybody off guard was the housing starts numbers missed massively. It was an atrocious print. It came out at 167,000 units annualized for January. That is a level we haven't seen since the last recession. And if we were to sort of normalize at that level and see that level sustained for any period of time, we're looking at, I'm not kidding, hundreds of thousands of jobs shed from just the construction industry alone.
Sure.
That sort of a print is, it's just very bad news. We cannot see housing starts come in that low. But yet I'm not sure what would see them rebound back to the levels that they've been. We've been averaging 210,000 housing starts here in Canada, which is way above our demographic demand. Yeah. We've outbuilt our demographic demand substantially. Our demographic demand is kind of in the 185 range. And so the call now is that, we're probably going to settle back in that 185,000 range. My thinking is if we've outbuilt it for a decade, there's a very good chance we're going to undershoot that level for a substantial period of time, and it's going to be an enormous drag on the economy and the labor market.
Not exactly what you'd call a soft landing.
Well, that's my point. I mean, if we're talking about a soft landing, the people who are calling for that have some tough questions in my mind. Where's the growth going to come from? You can't expect housing starts to continue at any sort of a strong level anywhere near 200,000. Mm-hmm. I mean, if you look at the level of existing homes for sale, it's very high in most Canadian metros. And then if you look at the number of units under construction that are going to be hitting the market shortly, it's also extremely high. So, I mean, if you're a builder and you're looking at falling sales and sky-high inventory and a ton of new inventory in the pipeline, I mean, why would you keep building, right? So, the pullback in housing starts is just a logical reaction by home builders, but it's going to be an enormous drag on the economy. It was entirely expected by people who saw how much of a driver that industry is for our economy. But it seemed to catch all these economists who are calling for a soft landing entirely off guard. Comical.
Ben Rabidoux from theeconomicanalyst.com. You can follow Ben on Twitter at Ben Rabidoux, and I'll spell it out, Rabidoux. Don't forget the free seminar, Toronto Real Estate, What's Next, at the Marriott Eaton Centre Hotel in Toronto, Thursday next week, the 21st of February at 7 o'clock. And more details at realestate2013.ca. Hey, Ben, thank you for your time. I appreciate it.
Always a pleasure.
Thanks to our guests, Adrian Ash, Marin Katusa, and Ben Rabidoux. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.